What's up guys? In today's video, I'm going to give you guys 3 different DeFi gems that could be the next GMX. Now, you're probably asking yourself, what is GMX? Well, throughout the 2022 crypto bear market, GMX was one of the best performers in the market, rising from, actually it was below 10 bucks to at its peak over $90, and it's still consistently rising. It has done almost 126 billion, like with a B, dollars in trading volume, which is astronomical, especially for a DeFi protocol, considering that the total TVL that we have in DeFi is around 60 billion. But if you look at the comparison of the total futures trading volume in general, it's actually just peanuts. The DEX market share is still only around 2% of the futures trading volume across all of the different exchanges. And this is why I'm giving you guys these 3 different DeFi gems. The very first one is going to be Gains Network. Most of you already know this. I've done a couple of videos on this, but Gains Network allows you to trade not only crypto assets, but it allows you to trade a couple of other assets like Forex and different stocks. As you can see here, you can trade Apple, Bitcoin, the Euro, SPY, gold, Aave, Airbnb stock, Cardano, Algorand. There's a bunch of different things you can trade with Gains Network. Just think what GMX is, where you can trade a couple of different crypto assets like Bitcoin, ETH, a couple of other random DeFi altcoins like Link, Uni, etc. But Gains Network actually takes the next level and allows you to trade several different assets. I'm a stats guy, so I like to look at a lot of the data. If we take a look at the daily trading volume as well as the daily traders, this is daily trading volume. It's kind of cut off. Let me scoot it over a little bit so you guys can see, so I'm not fudging you guys. And boom, daily trading volume, I told you. All right, so the daily trading volume is basically up only, and especially ever since their Arbitrum deployment. And I'm sure you can kind of see where the Arbitrum deployment was. Well, it's right about there if you see the mouse circling, whatever. And you can also scroll down and see that most of the volume is done on Arbitrum. Arbitrum is the green section. So these guys are on both Polygon and Arbitrum, but basically the stats are up only on this guy. And as you can see here, for the most part, traders in the loss. This is important to understand because the GDAI vault is winning when the traders are losing. And that's why you see the daily GDAI price going up. And whenever this GDAI price gets large enough or too large, the GNS token is actually burned. And as you can see here, the GNS market cap and the token supply is starting to hit a tipping point and potentially starting to trend down. And this is as there's more volume on the exchange and the GDAI backing increasing. The GDAI backing increases as traders lose. Currently on Polygon, if you're staking GNS, you get about 8.54% and about 5% respectively in Arbitrum. And this is paid in the DAI stablecoin. Now, if you have the DAI stablecoin and you're staking in the GDAI vault, you're actually earning about 8.3% in stables. But keep in mind, there is risk involved when you're depositing into this vault if traders are profitable, but if they lose, you actually keep on winning. And over time, you can see here, GDAI has steadily been trending up. So quick recap of Gains Network. You can see here that the daily traders have been increasing and the traders' profit and loss has been in the negative. This is beneficial for the GDAI stakers. You can kind of look at Gains Network and the GDAI stakers as like the casino. And the traders on the other side, those are the people coming to the casino. The thesis on Gains is that as more people trade and traders trade, over time, they are actually going to be losing. This actually makes sense because if traders have a 50-50 chance of winning and they have fees, it's going to be favored into the side of the casino, which is the protocol itself. The reason being is if every trade is literally just a 50-50 chance of winning or losing, you tack on those fees, favor is automatically skewed to the protocol because they're charging the fees and profiting from those fees. So if that trader is neutral, doesn't make any wins, doesn't make any losses, well, they lost from the fees. So just something to keep in mind. It doesn't end there. The GDAI tokens are actually automatically accruing interest. And if you wanted to get a loan against them, you can use something like My Finance and be able to leverage your position if you want to increase your interest but that's entirely up to you what you want to do. My Finance allows you to get a interest-free loan where you only have to pay 0.5% to close your position. Also understand if traders are profitable and the GDI token loses its dollar value, make sure to manage your loan accordingly on My Finance if you're using this. The second protocol is actually two different protocols. It's kwenta.io and Synthetics. The reason why I say Synthetics and Kwenta is because Kwenta is built on the Synthetics tech stack. As you can see here, this is just one of the protocols that's built on Synthetics. Synthetics allows users to trade several different synthetic assets with basically zero slippage. And this is done by minting SUSD using the SNX token. SNX isn't the only asset that you can use to get SUSD, but that's the asset that you would stake. You can also get SUSD using ETH, using the CDP vault on Synthetics. Now let's go ahead and head back over to Kwenta. Kwenta is the UI that you are using in order to trade up to 25x leverage with deep liquidity. And that is using Synthetics as its tech stack. As you can see here, there are several different assets you can trade with, and you're able to use up to 25x leverage. Out of the perp dexes, Kwenta actually has some of the lowest trading fees. In fact, with the latest incentive program, you're actually basically being paid to trade. Now, let me go ahead and explain this. As you can see here, there's a little section down here that says trading rewards. Oh, what the snap? Let's try that again. As you can see here, you have a section that says trading rewards, trade to earn Kwenta and OP rewards. Synthetics is actually giving a share of the OP grant that they received in order to incentivize trading across several of their different perp dexes. And Kwenta is actually driving the most volume on top of Kwenta. It's actually several $billion. If you take a look at the stats, you can see here the daily volume on average is probably around $100 million. By comparison, that's almost similar to something like Gains Network. And as you can see, if you zoom out on all the stats, you can see they're pretty healthy with a total volume of $5.5 billion. The $2.5 billion was just in the past 30 days. And just by comparison to other similar protocols, if you look at the market cap of GMX, it's about $624 million. Whereas Gains Network is about 189 and Kwenta is about 66 million. Now, you're probably thinking like, wait, no, the fully diluted is $340 million. Well, actually, it's not. Let's go ahead and take a look at some of the actual data that's on Kwenta. The actual circulating market cap of Kwenta is about half that, with being about $37 million. And the total circulating Kwenta tokens are about 63,000. Now you're probably asking yourself, where in the world is that coming from? So if you look over on the Kwenta dashboard, if you are staking your Kwenta token, you are going to earn about 51% paid in escrowed Kwenta. So this escrowed Kwenta is locked for a full year. And if you take a look into the dashboard, if you want to vest it early, 90% of the tokens or of that fee will be given to the treasury. And as you can see here, so let's say if I have 100 Kwenta tokens and I decide to vest them early because I farmed these 100 Kwenta and I just wanted to cash out, well, 90% of that will actually go back to the treasury and only 10% of that will be liquid and able for me to actually sell this token. Hence why the actual circulating supply is much smaller than what it seems to be. And you can also go into the rewards tab if you're an active trader on Kwenta and you have staked Kwenta tokens, you're actually going to farm additional Kwenta. And this is what it would look like when you're claiming rewards on Kwenta for trading. So if you're doing a bunch of trading volume on Kwenta, you can see the claimable rewards you'll receive. The trading fees that you do receive is based on a formula. And the TLDR on the formula is the more the volume you trade compared to everyone else, the more you earn. And the more Kwenta you stake, the more Kwenta you earn. Now keep in mind, these are escrowed Kwenta tokens. So these are also locked. But what's really cool is now they have optimism rewards. So you actually earn a share of OP rewards trading on the platform. So you're getting escrow Kwenta and you're getting OP rewards. This is starting now. So make sure you guys go ahead and check that out. And if you're not that good at trading like me, well, that's okay. You can check out the leaderboard that they have on Kwenta, and you can click out a couple of these different traders and see what they are doing. And if you wanted to, you can copy trade them. I'm not telling you to do that because, I mean, every time I trade, I just seem to get wrecked. It doesn't matter if it's my trade or copy trade, but you can select and look at all these different users and look for one that has a open trade. So kind of just click and look around and see if you can find one. And you can also take a look and see how they're trading. So here's an example of one that's open. This guy opened a long for Avalanche, probably going into the Avalanche conference that's coming up. This guy has a long open and he seems to be in the green. Also, make sure you aren't copy trading someone who is getting wrecked. These are some of the guys that have a green P&L. Make sure you don't go to someone who's like getting wrecked. These are the top traders. This is on the leaderboard, so you can check this out. And just because a trader is profitable now doesn't mean they are profitable in the future. And it doesn't end there for Kwenta. The one last thing I want to talk about is SIP 2002. This is a synthetics proposal that was passed to where a portion of the trading volume that occurs is given as revenue share. And being that Kwenta is a huge volume driver on synthetics, they're actually going to be earning a large percentage of the fees. And these are the different tiers for the partner rewards. They're probably going to shoot around the 5% fee rebate because they are going nuts and ham with the amount of volume and fees they are generating. And of course, speaking of Kwenta, Kwenta did sponsor the channel. You guys can check out the details in the description below. There is a link so you can check out Kwenta as well. But Kwenta allows you to trade synthetic perps with up to 25x leverage. I like Kwenta, and it's an honor to have them sponsoring the channel. So make sure you guys check them out and play around with it. They also implemented Smart Margin, the latest update to the dashboard, so you can implement your stop loss and take profit positions so you can go ahead and sleep better at night. Third DeFi gem is Level Finance. Level Finance is a funny story for me. I ended up buying this around 15 cents, selling around 9 cents, and having to buy back in around $2.50. But let's go and explain why I'm bullish on Level Finance and why I think it's a DeFi gem to keep on the radar. The stats on Level Finance have been nuts and ham. If you take a look at the total trading volume on Level Finance, it's done over $12 billion in trading volume since inception. And if you take a look at some of these charts, you can see here that it's been up and to the right, and the stats are nuts and ham. What's important to look for in the stats on a perp dex, something like this, is that the fees are coming from leverage. As you can see here, leverage trading takes up a bulk of the fee percentage that this receives. You don't want to see something where all these bars are orange because that means most of these come from swaps. Swaps are good and all, but the revenue that the protocol generates is particularly from leverage trading. That's where it gets its butter. So if it's getting its butter from swaps, it's not getting a lot of butter, like volume-wise. And as you can see here, the fees are paying pretty well. And you can see here that traders are constantly losing. And what that means is that's actually like a win-win for the LP providers. This is not a GMX fork. Level Finance is a little bit different by allowing users to stake in these different tranches that have different risk factors, earning a different APR. So if you wanted to go into a lower risk tranche, you can earn something around 80%. And this would be made up of something like ETH, Bitcoin, Cake, BNB, but different weights. See here that it's more heavily weighed to the stablecoin side. And if you look at something like the mid-level tranche, you can take a look at and see the distribution of the tokens, and you can see it's more heavily weighed to BTC, ETH, and USDT instead of just the stablecoin side. And then if you go into the junior tranche, which is more risky, you can see that it's more heavily skewed to ETH, Bitcoin, and BNB. There is a little bit of a allocation of Cake in there as well. And the best way to understand the tranches is that the more risk you have, the more heavily it's weighed to some of the other coins besides being a stable coin. Now, there are a couple of interesting, unique mechanisms that I really like about Level Finance. The first has to do with the integration of LGO. LGO basically entitles you to a portion of the treasury. So if you go into the DAO section and go to redemption, The only way to earn LGO is by staking your level tokens, or they also have the auction as well, which is a newer introduction. I'll show you guys that in a second, but you can see here the total LGO supply that's actually liquid is about 85 tokens. So if you had one of these LGOs, you can literally redeem them if you were in the snapshot. This happens like every week or so, and you will receive a portion of the treasury. And if you go into the overview, this shows you the treasury's liquid assets. And this is given to the protocol as there's more trading volume on there and fees are generated and so on. But if you take a look here on the level token analytics, you can see here there is a portion of the level tokens being burned. This LVL is being burned as people are going into the LGO auction and paying with the level token. So by comparison to some of the big boys like GMX, these are some of the numbers that I was able to crunch out. Based on volume wise, the GNS volume to market cap ratio is about 192. Level is about 245 and Kwenta is about 150. Based on this, Level Finance is undervalued compared to the other three. Now, fee-wise, you have GNS at a 7.07 PE ratio. You have Level at a 3.45 PE ratio. You have Kwenta at a PE ratio of not applicable. Why is that? Well, because they are not currently earning revenue. Whereas with the improvement proposal with synthetics, with the revenue share that's being passed, that is going to change the story on that. Now, GMX, using them as the barometer, these are like best in breed. GMX has just killed it 2022 and is still doing well in 2023. GMX has a circulating market cap to volume ratio of 201. So based on that, the ones that have a better ratio, again, is Level Finance. This is still standing out on it. And the PE ratio of GMX is 3.24. And the PE ratio of Level Finance is 3.45. So GMX seems to be beating Level on that PE ratio. But the PE ratios you have to take with a grain of salt. Why? Because GMX, stakers only get 30% of those fees. GNS, the stakers get 32.5% of the fees, so they actually get more. On Kwenta, the stakers only get inflationary rewards, so they kind of count them off the table for now. And then you have Level. The stakers get 10% of the fees, but they also have the option to redeem for the LGO treasury. So a little bit different than just earning yield in the form of ETH. It actually earns yield in the form of a couple of different tokens. So if you go over to staking, and you can see here to stake your level, you are going to get the senior LLP. If you go into the liquidity, the senior LLP is this senior tranche. So you're going to get Bitcoin, stablecoin, ETH, and some cake. And in general, it's mostly going to be weighed more towards USDT, the stablecoin. So going back to the tweet I made, also factor in, GMX does not have buybacks. If you go into TradFi, this traditional stock market, whatever, buybacks are actually beneficial for the protocol because this juices the earnings per share. Because if you have less shares on the market and you're earning more and so on, which will also make the PE ratio healthier. I would probably rather call this the market cap to earnings ratio instead of a PE ratio since I'm not going by the individual tokens. But you guys kind of get the point, just comparing the different protocols in general. Now, again, I want to remind you, GMX doesn't have the buybacks because there are no burns. GNS does when GDI balance is over the 110% collateral ratio. It goes back to buyback and burn the GNS token. Kwenta does this from early vesting. 90% of the tokens can be burned if they are claimed early. And for Level, you have it from the LGO auction burns. So it'll be interesting to see how this plays out. Now keep in mind these protocols are not without risk, especially with the perp dexes. They have a model that tends to drain the liquidity pool if the traders are profitable. but over time traders are mostly in the loss. I want to conclude this video with this Dune Analytics dashboard. This compares several of the different perp dexes in the DeFi space. So let's go ahead and take a look at this slide at some of the comparisons on the actual numbers that these guys are doing volume wise. If you just let's just do a quick scroll. Just take notice of Level Finance and Kwenta. So on 4/16, Kwenta did about 200 mil, Level about 279, and GMX did 221 mil. Bear in mind that GMX has about a $700 million circulating market cap. Level Finance is about a 50 million. Kwenta is about a 40 million, or actually probably closer to 50. Just the price is so volatile. So let's go and take a look at 4/17. GMX 231, Level 269, does more than GMX. Kwenta 113. Let's take a look at another. We got Kwenta at 43, GMX at 200, Level $332 million. That's pretty good. The next day, GMX killing it, 408 milli, Level 244, and Kwenta 141. Again, GMX killing it at 331, but then you also have Level doing 128 and Kwenta doing 95. Again, same junk, different day. The point I'm trying to make is the market cap comparison for something like Level Finance and Kwenta. They are doing some pretty high numbers. I'm not really mentioning a GNS in this scenario because, I mean, they were doing like 102, 107, 77 million, but GNS is about 3x the market cap of Kwenta and Level. In my opinion, just going based on the volume wise, Level Finance and Kwenta potentially have some catching up to do. And I wanted to add this to the Twitter thread as well. The total fees on Kwenta is about 20.28 million. So that gives it a market cap to earnings ratio, or if you wanted to call it the PE ratio, it's not really the PE ratio because I'm not splitting it up into the token shares. It's 1.82. Now, I understand there's no revenue share, and just to show you where I'm getting the data for the 20 million for Kwenta is right here. This is just from the margin trading fees on Kwenta. So just something to keep in mind and keep on the radar. And I'm not bashing on any of these protocols. In fact, I like Gains, I like GMX, I like Level, and I like Kwenta. I actually own all four of those. And there are some other protocols on here that I own as well. But just looking at it, as I showed you guys in the beginning of this video, DEXs barely reach about 2% of the total futures trading volume in crypto in general. I think there is some room to grow, and a lot of these guys can grab a market share. These type of protocols do well in both a bear market as well as a bull market, being that people trade in volatility. The only time that these may not do well is when the markets are stagnant and sitting still. But who knows? People get antsy. They like to overtrade. And that's not really saying that the LPs are going to benefit from it, because if traders are profitable, they'll lose. But obviously, over time, we'll see how it goes. And in general, for the most part, the model seems to be working pretty well. Anyways, guys, in summary, those are the 3 different DeFi gems that I like, and I think they are potentially undervalued. As always, time will tell. We'll see what will happen. These 3 are on the radar. Again, they are Level Finance, Gains Network, and kwenta.io. If you guys want to see what I'm doing in the markets and get more exclusive content that I don't show on YouTube or share on Twitter, you guys can join in the link in the description below. That is the Patreon link for Discord, and there will be links to some of these different DEXs: Level Finance, Gains Network, and kwenta.io. Proverbs chapter 10, verses 9. Whoever walks in integrity walks securely, but whoever takes crooked paths will be found out. Be good, be righteous. Peace.